Welcome to the weekly update, where I'll go over the action in the market for the week of July 8th through the 12th, and then we'll see how things look for the week of July 15th through the 19th. We had another up week. Didn't really come about all that easily. It looked like we were just going to go up and up and up. And then in Thursday's session, the market really had reason to go higher. And you'll have to excuse my voice after a long day of teaching English. The market could have gone up on Thursday, but ended up going down. The market could have gone down on Friday, and it ended up going up. And we're potentially seeing some real shift in the market where, at least right now, we've seen this before only to have this fall apart. But it looks like maybe the broader market is showing an improvement. It's not just the big stocks that have seen some strength this past week, but we want to see more follow through from this. This would be more positive for the broad market and the S&P 500 if we saw more than just a few stocks really driving things higher. That was also helping the index itself, but internally, we want to see a lot of confirmation that things are going up on a real solid foundation. Some of the negative divergences that we were seeing are starting to go away, and some of them are showing a big improvement. Before I get started, I always do this in the weekly video. I do post videos each day, and that's the real foundation of the analysis that I do. This video, you have to excuse my voice again. And I do all these videos take one. I don't edit them. So I hope it doesn't bother you too much, but I do videos each day, and the weekly video that I do here, this is seen more as a supplemental video. Yeah, it gives us a bigger picture look at what's going on. But if you really want to see the story unfolding, it really comes about through the daily videos, and I provide commentary and analysis. And yeah, the videos are longer. Last week, I had anywhere from 40 minutes to almost an hour on some of the daily videos, even though it was kind of a boring week. There's a lot of things going on under the surface that I try to point out in those videos. I do put a PDF available in the description with every video that I upload, whether it's a daily video or a weekly video or the other videos that I post. And that's available so you can see the slides that I'm looking at right now. You can look at the charts that I'm going through as well. I do also update a thing called Pivot Points. That's on the YouTube community tab. I can't do that on Rumble. And there are pivot points that are good for the whole month. And that's a daily chart that I update with the candle for that particular day. And then there's a chart that updates every day based on an intraday chart. And those are different each day. I do have a private Facebook group, not a big group, not a lot of activity other than me just posting when I'm putting up videos. But if you don't really want to get into the membership program that I have, but you still want to have a little bit more communication and you do belong to Facebook, you're more than welcome to join that group. And I do really go through and look at YouTube and Rumble comments, and I try to respond to all the legitimate ones. Apparently, there's another webinar going on. I played whack-a-mole. I had one person who they copied and pasted their same spam garbage in like 5 of my videos, all saying the same thing, all telling me that my videos are great, but yet they're not even watching them. So how do they really know? So it's just not a game that I like to play, so they get deleted. Legitimate comments back and forth, whether you agree or disagree, those are always welcome and will be treated with respect. I also post on Rumble. There are times when I have trouble on one platform or another. It was about a year ago, I think, that for some reason, out of the blue, the robots for Google went through and they flagged my channel and shut me down. And I was down for a few hours until some human being could go in and say, no, this channel isn't violating our community standards. But that can be a number of hours, and it could even last a couple of days, depending on what time it is that these things happen. Now, I haven't had that happen lately, but that can happen at any time. So I post on YouTube and Rumble using both platforms as a backup to the other one. And here's the link to the Rumble channel. Also, I do have a program. It started at the beginning of June. I was going to lock that down in July, and there's some logistical reasons why that hasn't happened. And I'm going to be locking it down in August and starting some trial periods and things like that. It's going to be $97 a month. And even if you have a longer term portfolio, this could really benefit you. I have courses that I've created myself. I'll be doing some live courses that are like whittled down version of the longer courses. There's a community that we can talk things back and forth. You have more direct access to me. We can set up a time on Skype or Zoom or Messenger or whatever platform you use. And so consider that if you want to really take this whole thing to the next level. There's a link to the website and a link to more videos that talk about the program in the description below this particular video. You can also email me directly if you want to do that. Also, I kind of alluded to this earlier. The daily video is really the foundation of my analysis, where all these other videos that I do throughout the week, the supplemental videos, that might be every few months. And there's a lot of additional supplemental videos that I plan on doing, that I'm doing research for, that kind of go outside of the program, but are still related anyway. And those will only be available on the website if you find those useful. There's a few that are on YouTube and Rumble now that I did about a year ago, but I want to do this on a more consistent basis with some of these supplemental videos and really dive into some deeper topics. But I don't necessarily want these to be public videos. Also, another channel that you may consider if you're more longer term, if you haven't discovered it already, this is on YouTube. This is Schiff Capital, and it's a video that Chris Schiff puts out every week. And he's a money manager where I'm an educator, and he puts out a really nice video each week that would be well worth your time. There's also another channel that I would recommend known as the Kindle Report. This is Bob Kindle, been around a long time, has some unique perspective on the markets. He does have a newsletter. In the beginning of August, he's pretty much doubling the price of having access to that. So you'll have to decide if that's something that is actually worth it. I'm paying like $8 a month now, and it's going to be doubled to like $16, $18 a month or something like that. Okay, let's go back and talk about what happened this past week. We were up 0.87%, not a real strong gain, but we were still up nonetheless. We were above average with volume. Now, we've been below average, but over the last number of trading sessions in this past week, we have started to see a pickup in volume. Now, we're also in a period of positive seasonality, where stocks tend to go up at the early part of July. But be aware, the second half of July can often be kind of rough. Now, we don't know if it's going to play out that way or not. We've broken a lot of seasonal historical patterns in 2024, and we never really stick right to them. We just use them as a guide. We don't really make decisions, at least I don't make decisions based on what's happening seasonally, but I look at a number of different seasonal charts at the end of this video from a number of different sources and just say, okay, that's interesting. And we have a tendency to go up or down during this time, realizing that we have to look at the charts here to really tell us what's going on. We are positive with our technicals, and we're switching back, and we're still looking positive on the daily charts, both in the short, intermediate, and long term. And a lot of the damage or divergences or things that have been showing some weakness to this point appear to be getting better. But we have seen that before. We need to see more follow through with this. But the S&P index itself is still quite strong on all the different time frames. We did get CPI and PPI this past week. CPI came in friendly, and that could have helped the market go up. It went down. PPI came out on Friday. That was stronger than expected. The market could have gone down, and it went up. So that's why when you try to apply human logic to the market, it's often quite different than stock market logic. That's why I look at charts, and we try to remove as much emotion as possible. Because if you say A plus B equals C, well, that may make sense to you, but that may make no sense to the market itself. And we want to keep an eye on the geopolitical concerns. There's maybe something will develop over the weekend, but there's some real uncertainty right now about what's going to be happening in the U.S. presidential race. But that's only one race. And the markets don't care if we have a Republican or a Democrat president. We've had up times and down times, and you can't give credit to whoever is or isn't the president. That's just the way things go, and that's the way America was designed. It's Congress that we really need to pay more attention to. And Right now, we have a split Congress between the Republicans and the Democrats, and the market likes that because that makes it so Congress can't really do very much. And what does Congress do? They pass rules, they pass regulations, they try to constrain what the growth that's going on in the economy. So when there's a split on a political basis, you might find that frustrating. But from a stock market basis, the market does end up doing better in those kind of environments. And there's also all these geopolitical things going on outside of the US as well, between Russia, Ukraine, and the Middle East. And those can come in at any given time. And even something that we have been kind of watching, but not really talking about. Anything can happen at any point, and that can have an impact on the market. Our trend right now, we are still in a strengthening trend. I'll show you this chart. It's positive. The green line is above the red line and going up. So even in the long term, we're still looking pretty positive from a trending basis. Just some bullet points here. We were up 0.87%. One thing that might be starting to shift is that for all of 2024, the first 6 months, the small caps were a real disappointment. They were just range bound. We had a good December in 2023 and it looked like, okay, here we go. And we call that the January effect. Well, once January hit, that effect seemed to fly out the window and we've been range bound. The mid caps have been stronger earlier in 2024, and then we're just kind of drifting sideways to even down. The last few trading sessions, these areas seem to be gaining some strength right now, but we don't know if this is a fake out or a breakout at this point. We just follow it day by day. And the mega caps, which have really been holding up the market, they actually underperformed along with the NASDAQ this past week. CPI was taken as friendly. That was on Thursday, where PPI came in stronger than expected. That was seen as a little bit of a threat, but yet the market went in opposite directions. Interest rates, this is helping the market. We're coming back down a little bit here with the 10-year yield. We're at 4.19%. That gives support to stocks. The interest rates going down are what helps small caps and mid caps to do better, because a lot of these companies, they're not really big. They can't really soak up all the higher interest rates the way maybe some bigger companies can. And so they have to borrow a lot of money, and the more they're paying out in interest is money that they're not making towards their earnings. And the dollar index was also down, and this also gave some support to stocks. The market likes a weaker dollar. We did have the banks that came out with their earnings, and they were good earnings, but all these stocks went down. JP Morgan, Wells Fargo, Citigroup. It's looking out into the future. And we saw a little bit of this front running going on. Another way to call this is buy the rumor, sell the news. The bank stocks are doing pretty well during the week and really helping the market out. And then once the earnings comes out, poof, everybody starts selling, even if it's a stellar report. That's kind of what we saw in Friday's session. 2 times every year, Fed Chair Powell, or whoever is the chairperson of the Fed, has to appear in front of Congress. July is the second time of the year that this happens. And one day, the chairperson appears before the House. The other time, they appear before the Senate. The comments that are said at the beginning are usually prepared, and they're kind of a surprise the first day, but then they are the same comments the second day. What is looked for are the Q&A, the question and answers, to see if can we get any hints as to what's going on as far as what the Fed is doing, but nothing really developed out of both of those days this past week. So it was nothing that the market hasn't heard before. Also keeping an eye on this longer term chart of CPI, because we're still in this phase now where the blue line continues to go down. And even though this chart's over a year old now, that's the orange line, we're still following the same basic path down. The reason I always show this is look at what happened after that. Now, we don't know if it's going to happen like that, but it has happened before, or maybe some variation on this. I mean, you can watch other YouTube videos, you can go to blogs, you can look at the headlines, and there's, for every person saying the market's looking really good right now, there's probably 10 people saying we're going to have a 50% crash, or things are topping out and going to go down. And I listen to a lot of those things. I think they're interesting. Sometimes I actually get some useful tools from those folks, but I don't take anything that they say to heart. I look at the evidence. What are the charts actually telling us? Everything, knowing that things can change. at any given point. That's why I do the daily videos, is to see these things unfold and we can get on top of things much quicker. Also, we're coming down a little bit closer to that 4.02% level for the 10-year yield. When we're above that level, according to the RenMac research, that's when it's starting to bite into corporate profits, and that ultimately goes over into the earnings per share. If this can come down and even drop under 4%, that would be more positive on an earnings type of view. This is a new chart, and I'm going to start showing this from now on because we're seeing some weakness, potential weakness, but we've seen this before only to have it turn strong again with the employment situation. Now, this is why the Fed is keeping rates for higher for longer. They want inflation to come down to the 2% target, but they're also justifying keeping these rates higher for longer because the employment situation has been holding up so well. There's a chart put out by the Fed that says, okay, now 26 weeks, that's half a year. If you are unemployed for 27 weeks, you're going into your 7th month of being unemployed or longer. That we want to keep an eye on that to see if there are some longer term weak areas that are starting to develop in the employment situation. Now, there's all kinds of people out there to come up with all kinds of their reasons that, okay, it's because of illegal aliens are taking a lot of these jobs. A lot of people are taking part-time jobs. Yeah, all that stuff's true. But the market uses these charts and they don't come up with these little independent little conclusions. There's like mass movement amongst, okay, what is the data? Even if it's manipulated, they still follow that as well. I don't know how many times I've watched a video or read something where somebody has this massive conclusion about things and they're basing everything on that, and then it doesn't play out that way because the market pretty much ignored that same conclusion that they're reaching. So we follow what's going on, and to a degree, we follow what other people are following. I have found over the years, it's not so much that technical analysis gives you an edge to see things that people don't see. What we're looking at are the same things that millions of people are looking at the same time. And then that ends up being a self-fulfilling prophecy. I found that to be a better edge than trying to uncover something that is necessarily brand new. But we're starting to go back up a little bit. We're above the black line here, above zero. When we look at those folks that are experiencing being unemployed for 27 weeks or longer, if this continues to go up, you can see these other grayed areas on this chart. This is typically when we went into a recession. And that's kind of one thing that we're waiting to see. Other areas of the market seem to have been through their difficult time and they're showing some improvement now, but employment has not. And if this is the last area to fall before we turn a lot more weak as far as the economy, this is the area that we want to be watching. And this is a chart that we want to look at consistently. All right, then there's another site called IsabelNet, and they put out some charts, and I include them in the daily videos. And then in the weekly video, they update it over the weekend for Saturday, and I use some of their charts in this video as well. This is looking out into the future as to what is the earnings outlook going forward. And they're pretty much going up across the board. That's why I have the red arrow on here. And that justifies stock prices going up because earnings into the future are also looking to go up. Then we look at the weekly equity fund flows, equity or stocks. Is money going into stocks or coming out of stocks? We can look at this more on a raw basis here with the blue bars, but then we can get a little smooth effect here with a 12-week moving average, and money is still going into the market. And this is like fuel for the market to actually go higher. Inflows into U.S. large cap funds, they're on pace for the second largest on record. Okay, a lot of money is going into these large cap funds. We might be seeing that start to change now, but we've seen that before. I've said this 5 times already. We can't front run this stuff. We have to see these stories unfold as they are developing. But right now, the large caps, they're really the best performing areas of the market right now, but we might be starting to see a bit of a shift there. And looking at gold, it's discounting a collapse in real rates where they're anticipating gold to go up. And then real rates, that takes inflation into account. And then we're comparing them here where rates might be going back up here. as because see, they tend to go in the same basic direction. We're seeing a real wide separation between the two. Does that mean gold is going to come down? Don't say that to any of the gold bugs out there. They're totally convinced we're going to gold a million. Okay. And are interest rates going to go back up? What's going to happen here to put this chart more in line with each other? And this goes back to 2006. So just something that we want to watch as it unfolds. Then, what are your biggest concerns right now? We're seeing a lot of increased concern about the US elections, not just for the president, but is it going to be Democrat, Republican, split between the two? And everybody has an opinion about that, and everybody thinks they're right. We just have to go with what actually happens. They're dropping off a little bit here with the geopolitical risk, but this could go into first place easily. We see more of an escalation between Russia and Ukraine. If NATO gets more involved, there's a NATO meeting going on right now in Washington, D.C. What's going to come out of that? How's Russia going to react to that? What if Ukraine ends up joining NATO? And then there's all the things going on in the Middle East. There's a real buildup there between Hezbollah, which is like the big boys. That's the major leagues compared to Hamas, which is Gaza. What if that escalates? And I'm keeping an eye on that because I'm planning a trip to Israel this fall. It already was canceled last October when I plan on going. We'll see if that's going to happen again this time. Also, I'm keeping an eye on the Russia-Ukraine situation because I'm right between that. That's where I'm living right now. And I border Poland, which is a NATO country. So if for some reason these videos are not being posted, it's because I'm on the run for some reason. But we just keep an eye on these things. We don't freak out. We don't just overreact and think, okay, we've got this all figured out right now. We have to watch this unfold as it's actually coming about. U.S. fiscal policy, that mainly has to do with what is the Fed going to do? Is there anything coming out of Congress as well? And there's a little bit more concern now about going into a recession. Also, we're seeing a little bit of a problem here with commercial real estate. And there's two sides to this. There's one side that I got from Bob Kindle. He says, nah, don't worry about commercial real estate. It's a good old boys club. They're just going to sell things off to each other and everybody's going to make out fine. Well, on the other hand, you've got these commercial real estate properties that aren't seeing the vacancy rates that we saw before the lockdowns. And so there's a lot of empty space out there and interest rates have been going up. And a lot of this needs to be refinanced over the next year or two. And if interest rates are up, that could really create some problems there. So we're kind of watching that. Inflation had been more of a concern, but now it's dropping off. And there's other things that are listed here. I just usually hit the top areas because this can change all the time. Okay. Then looking at the markets are pricing in the first rate cut in September 18th. And I'll confirm that when we get to the Fed watch tool charts that I show later on. And it's almost, we're up into the high 90s now with the probability that is going to happen. Market implied U.S. recession probability, it's coming down, but things could happen. The economy could shift. Some kind of black swan event could happen. Some kind of an event could really overtake, like the COVID lockdowns or something like that. And then that could put these probabilities back up. But for right now, they are continuing to decline. And then the 30-year, this is the 30-year bond, it's down 54%. If the market was really concerned about going into a recession, this would be going up, not going down, because people would be trying to lock in these longer term rates for a longer period of time at a higher rate than what we're at right now. And the fact that this is going down, and this says the total return since 1919, and of course you all remember what it was like back then. That was the Treaty of Versailles right at the end of World War I. And we're really coming down right now. If we were more concerned about going into a recession, this would likely be going up. Then FactSet did have a couple of blog posts, and I focus more on their earnings. It says S&P Financials, that's the banks, and all the financial sector, with their second quarter earnings preview. Now, they've already come out for the big banks, and there's still more that are going to report. They're expected to report the largest decline, and that's what we're seeing here for the banks, where other parts of the financial sector are holding up a lot better. Financial services and consumer finance seeing not much growth, but not much of a decline either. And then looking at earnings growth, where they are not seeing much growth right now, but they are seeing it really picking up in the fourth quarter. we're into the third quarter right now. They're seeing things getting better as we get into the fourth quarter of 2024. Then S&P will likely report earnings growth of at least 12%. And that's pretty healthy right now. So what we have here, past earnings growth, and then the gray area, that's the projection or the estimate. And they're anticipating that it's going to be up, and that helps support stock prices. And then these are the earnings surprises, whether a company will beat to the upside or the downside. And I go into a little bit more detail in that in some of the daily videos. When you're an analyst and you're looking out 2 years from now, you can come up with whatever number you want. But as you get closer and closer and closer to the actual date of your projection, you're going to refine that, and you want to be closer to reality. And they have a tendency to really make those forecasts go lower. And that's a very common thing. But we're not really seeing that in the second quarter of 2022. And I do talk about that in the video for Monday's session. But this is just showing that the surprises, there are some here, whether to the upside or to the downside. But then again, that doesn't necessarily mean the stock's going to go in that general direction. We can see a run up like we did with the banks. They come out with their earnings. The earnings look good. Stocks sell off. We can see other companies. They're having a really rough quarter. Their earnings report comes out. It's pretty bad. Stock goes up. So there's stock market logic for you. Here is the intraday chart going back to Monday. We were pretty quiet. And it looked like, okay, Monday, Tuesday, Wednesday are going to be nice and quiet because Thursday, that's when CPI comes out, and Friday is when PPI comes out. Well, we were off to the races on Wednesday. We gapped higher, and it looked like, okay, maybe we'll just come back down in here to this nice, neat little range that we've been in. No, we took off. We started to break above 5,600 for the first time ever. And rarely do I have to put R3 and R4 on these charts. I actually have to calculate these myself. The software that I use, it automatically calculates R1 and R2, as well as S1 and S2. Well, we broke above those. And this range was based on what happened on Tuesday. And you can see we didn't see an awful lot of movement there. And then on Thursday, we saw the CPI come out, and we had a nice little thrust to the upside at that point. And then we just went down from there. And then PPI came out stronger than expected, and we just kind of took off. Now, one thing that we saw near the end of the close-in Friday session is we gave back a lot of those gains. We were still up on the day, but we did see an awful lot of selling going into the close. So for the week, we had the NASDAQ 100. Now, this is just the 5 trading days for the week. It was down less, or a little more than 0.5%, where all the other indexes ended up being positive for the 5 trading days. Going back to the beginning of the year, we're now positive across the board. We had been negative with the small caps, this black area here. They're now positive on the year. And then looking at the different sectors, this is sorted according to what did the best. And since we had an up week, real estate, which has been a really frustrating area for a lot of folks in 2024 because of interest rates mainly, it really saw an improvement this past week. And utilities, also, that's another area that we've been keeping an eye on. Is it going up because of AI and all this electricity that needs to be used for mining for cryptos? Or is this more of a defensive play that the market does? They start to get into this type of a area when it's concerned that the market's going to go down. We don't know the answer to that right now. And you can come up with the reasons for both sides at this point. If we look at the bottom, communication, this has been one of the darling areas, and this is what's really been helping the market to go higher. It was actually down this week where all the other sectors ended up being up. So the next chart is sorted in a different way. It's called the scooter score. The higher the number, the better looking that particular sector, where we have tech, communication, and utilities looking the best, where tech is the only one that's in the 90s right now. And we're seeing some improvement from these other areas, not up above 50 yet, but some of these have been a lot lower than where they had been before. Then for the week, we had a lot of the different sectors that have been showing some weakness, like real estate, healthcare. That's another defensive area. Materials had been under pressure. Industrials have been under pressure. The financials did fairly well. And then some of the other areas that have really been leading the market higher, like communication and tech, those actually saw losses over the 5 trading days of the week. Going back to the beginning of the year, though, we still have tech and communication positive. All of the other sectors are still underwater when measured this way. Now we look at the relative rotation graph. Are things rotating and getting stronger, or are they rotating and getting weaker? And that's what we try to pick out with this particular chart. The top right quadrant, you have to think back to your geometry class. This is the plus plus area, so these are the strongest areas. Now, utilities have been strong for a lot of the year, but you see how they're coming down and the tail is really long. They're rotating out of being really strong. And then we had energy, which had been doing quite well earlier on. It's actually red and turning much more negative over the past year, where we have the tech sector. That's really the area that's been doing well. We're seeing some improvements in real estate as well as discretionary. This has been a disappointing area. A week ago, this was red. Now it's starting to turn blue and show things a little more positive here. Then I break it out according to this chart here, where we still have utilities, tech looking the best, real estate and discretionary, showing a little bit of an improvement there. All these other areas continue to show some weakness. Then I look at the indexes and go back over the year, and I do a relative measurement with the Wilshire 5000, which is a broad market measure. Okay, this should be the Wilshire 5000, not the SPY. Okay, so there's a typo here on the chart. But we're seeing where the NASDAQ 100 has been doing well, not a surprise there. The S&P 100 and the S&P 500. The utilities had been stronger, but they're starting to drift lower now. We're seeing some improvement, but it's not showing up here yet with the mid caps and the small caps. And transportation, that's still an area that we're not really seeing a lot of improvement with right now. So the NASDAQ 100, the S&P 100, utilities, and the S&P. These have been the stronger areas in 2024. The red areas down here have been the weaker areas. Sentiment, we're finally starting to tick up. What was causing a problem here is we were seeing these negative divergences, which this particular index uses to determine if we're getting fearful or if we're getting too greedy. And we were getting lower readings with this as the market was going up, which is usually not what happens. When the market goes up, this has a tendency to go up. They go more in tandem with each other. But we were in the neutral area and we're finally ticking over into the greed area. I just say it as positive. I don't necessarily see it as greed. We're coming in at 56 right now. And then this is a chart. So we are above 50 and going up and showing some improvement here. So this is also for the time being looking more positive. And when it's moving in one direction or the other, we go with that. We tend to follow that and go with sentiment, whatever sentiment is doing. When we get up to the 75 level or around that area, that's when we start looking at using this as a contrarian indicator. And when we're going down and when we get around the 25 area, that's when we also start to look at using this as a contrarian type of an indicator. Active asset managers, and I have another interesting chart right after this. These are professional money managers who are paid to know what they're doing and manage money on other people's behalf. But they're also human beings. They also have peer pressure. They also have quarterly reports that they have to send out. They also have this idea that they're trying to beat the S&P 500 as far as performance. And they're getting pretty extreme. We did come down from the extreme reading that we saw a week ago, but it's still above this 90 level. And then showing this. This is put out by Real Investment Advice. It's a few days old, but this is based on a weekly chart. It says professional managers buy tops. They're human beings. Individual investors buy tops too and sell bottoms. Well, we're getting pretty high readings right now when you compare the active asset managers with what's going on with the S&P 500. This is a bit of a warning sign to us. Here's another reading of that same chart. The active asset managers coming in at 93.84, down from where it was a week ago, but still quite high. Looking at the VIX, this is the fear gauge. When the VIX is low, that means there's really no fear in the market right now, and we're still maintaining very low levels, both with the bar chart and the line chart. The line chart are closing values. The bar chart is the intra-week range. Ulcer index, this was really created for mutual funds, really dropping off here, showing there's not an awful lot of fear. Then this, and I have another breakout chart that I flip upside down to totally mess you up. This is the spread between risky and not as risky options. And as long as this is going down, that means there's not a lot of risk being perceived in the market, according to bonds. And so that's looking positive. Now, we were getting a little bit concerned here, but be aware, this is inverted from what we just looked at. I tried to do this to match up what's going on with the S&P. When this is going down, that means fear is increasing. Well, we were starting to see lower readings here, and that was causing a little bit of a concern. But over the last few trading sessions, this has started to go back up. So some of that fear seems to be going away. Also, to give this a little bit more context, this is the inverted version of the VIX. This just means when we get really high readings, we're seeing not a lot of fear in the market. The latest reading from Investors Intelligence came in at 3.5. We really start to use this as a contrarian indicator when it gets above 4. And then here's another sentiment indicator. We're coming right up to this dashed line. We're right on the border between being positive and maybe getting a little too positive. The RIDEX bear bull ratio, where folks are tending to be more bullish right now. When this goes up, they're more fearful. When this goes down, they're into the bullish funds thinking the market will go up. And the the American Association of Individual Investors, and that's you and me here. We're into this crowd. This is also an organization I belong to for decades. They come out with a survey every week. Are you bullish or bearish on the market? We're seeing this going up, but we're not necessarily to an extreme reading. When we get above this 80 level, that's when we really is that 30. I can't see these numbers here. When we get above this pink line, I can tell the color. That's when we start to look a little extreme positive. In the meantime, we follow the 50-period moving average, and that's tending to look more positive. And while that's been happening, we've been rolling with that as well. This is also another sentiment look at how would you be doing if you kept your money in cash versus getting in the tech sector. And this goes against human logic here. When this black line is going down, that means the tech sector is outperforming cash. It wasn't outperforming in 2022. You would have been better staying in cash. Now we're continuing to go down here, so the tech sector is still looking solid longer term. And looking at the latest reading from GDP now, we're coming in at about 2% for GDP. The takeaway from this is we still remain positive. When you look at the different forecasts out there, we're at about 2.5 to 2.25% to the upside and about 1.5 or so to the downside. And this is also a representation. We're really focusing on the second quarter right now. Like I usually say here, the takeaway from this is that we are positive with GDP. The Chicago Financial Conditions Index, as long as it's continuing to decline and it's below this black line, that's when it's more positive. And this is actually a week old now, the real-time SOM rule recession indicator. This is a little concern to us, but we're not going to see this again until August. We're coming up to this red line, and when we get above that red line, that's when we get concerned that we might go into a recession. And then this was a post from a week ago put up by Chris Schiavocco, who I mentioned earlier, who retweeted something by Nick Tamirio. He's supposed to be some insider with the Fed, showing that even though when we came out with this reading, it didn't break above that red line that I just showed you in the previous chart. Then we look at the smooth U.S. recession probabilities. We get nervous when we go above the red line. We're not even back above the black line, at least yet. Then this is a quarterly report, Bray Butters Kelly leading index. It is coming down after it had been going up. Inflation, we're starting a new quarter now, so we're not seeing an awful lot of data here, but as CPI and PPI have been coming out, and later on we're going to get the core PCE, we've been seeing the inflation actually ticking down a bit. This is what the market thinks the Fed is going to do. There's a 93.8% chance that when they meet on July 31st, they're going to leave rates unchanged. And that's pretty much where we've been with this. And this is just getting more locked in right now, day ago, week ago, month ago. What's turning interesting is there's a 90.3%, I don't know what I said earlier, but 90.3% chance that we're going to see a rate cut at the September 18th meeting. Now, this could change, but this is just what the market is going with for right now. And we look at how this has changed, they're also getting more of a conviction. And right now, day ago, this is CPI and PPI coming in and giving the market more conviction along this line. Looking at the Fed balance sheet, where when you look at this in total, it actually looks like it's declining, but it's actually going up here when we look at the latest numbers. And the market likes that. That gives support to the market. That's a form of quantitative easing when the Fed is actually coming in there and buying things. And then this is looking at it basically on a year over year basis here, where the Fed balance sheet is starting to go back up slightly. And we look at the overnight reverse repurchase agreements. What we watch for is any kind of real upward movement here, and we're not seeing that at this time. If you want to pause this and read through what this whole crazy definition is right here, because this is overnight reverse repurchase. I mean, okay, you're using like triple positives there, or triple negative, whatever. Okay, looking at our charts here, we're still looking good when we look at the advanced decline line weekly chart based on price and volume. Volume is still continuing to lead things higher, and that could be positive. And so far, that's been positive on the daily charts as well. We're also seeing an improvement here. We saw a real expansion of the new highs and really no expansion in new lows. We're not quite turning up yet with our 4-week moving average. We're starting to go back up with the 10-week moving average. We're seeing some improvement here. We're above zero with the advanced decline ratio and going up. Accumulation distribution. We're possibly looking a little extreme right now, and we're seeing pretty much that same thing on the daily chart. Although this is a weekly chart where we're above an advancing moving average. That's positive. But when you measure the distance between the indicator and the moving average, that's what this indicator down here does. And we're getting kind of far away from that. And we have a tendency to revert back to the moving average when we get too far away. So just something to be aware of there. Looking at our trend, this is still looking positive. The ADX is going up. The green line is also going up. We're above the moving average. This is on the weekly chart showing a positive trend. The Erin indicator, the green are buyers, the red are sellers, and we're pegged at the top here with the oscillator. It might be a little too positive, but it can stay up in these areas during extended periods that are quite positive. The mass index is not generating a signal now. This is a daily chart where we're looking pretty good. Even when we fell in Thursday's session, we still held support at this daily pivot, which is good for the whole month here. And we were able to bounce up off of that. We're above the 50-period moving average. We're above this trend line. We were above average with volume in Thursday and Friday session, but that's kind of started later in the week. And we're positive across the board with the Keller market model with all the different indexes that we look at on all the different time frames. We're still negative in the long term with bonds based on price. We're negative in the short term with commodities and the US dollar, and starting to turn a little more negative in the intermediate term with the dollar. And that's helping stocks. No changes here with the decision point scorecard, and everything is positive. So we look at our long-term trend channel. This is still continues to hold up, and we're actually getting near the upper end of this trend channel now. This is a chart that I have been showing in the daily videos. It's a weekly chart of the S&P. And for 4 weeks now, we've been above this R2 level. It didn't really provide any significant overhead resistance. And so this is looking more positive as well. We look at a 50-period simple moving average and compare it with price. The red line, that's the moving average. That's going up, and price is above the moving average, and that's going up too. So this is positive. Then in this chart, I use a moving average crossover type of system where we have a 13-week moving average above a 50-week moving average and prices above both. That's a long-term uptrend. We're also possibly getting a little extreme on the weekly chart here when we look at the McClellan oscillator. We're finally seeing some improvement on the daily side. This was one of the negative divergences that we saw. We're actually getting an extreme positive reading on the daily chart as well. And we're seeing that a little bit confirmed. Now, this could still go higher. You can see other times when it went up. We just want to be aware of this when it gets to an extreme reading. Also looking at the summation index, we're starting to go back up and we're above zero based on price. We are also looking a little stronger here based on volume. And right now it looks like volume leading price has been positive for stocks. We're looking better here with the Swenlin trading oscillator. We're going up based on price and volume, and we're above zero. That's looking positive, and we're also looking positive on the daily chart there. The bullish percent index, this had been a real disappointment. We finally are seeing a little bit of life here because the S&P was going up, but the bullish percent index was just chopping sideways and some days even declining. And this measures the point and figure buyer sell signals inside the S&P. To see solid strength inside the index, we want to see this going up. It is improving, but it still has more room to go to look even better. And then looking at the PMO, this measures momentum. We're going back up and getting close to this red line based on the indicator itself. We're crossing back above zero where we had been below zero based on price, and we're looking a little more positive here based on volume. And then associated with that are a number of different studies. The PMOs on the weekly chart, we're starting to get an extreme positive reading. We're seeing that on the daily study as well. We're going up with the buy signals, and we're starting to go back up with the PMOs that are above zero. This is suggesting that inside the S&P, things are improving. And then we're actually closing a little bit outside of the upper Bollinger Band here, and that doesn't happen very often. We're not showing that on the daily chart, but we are showing that here on the weekly chart, and that doesn't tend to last very long. So either the Bollinger Band will have to go up, or price will have to go down, or a combination of the two will have to get this out of being an extreme positive reading. Momentum is looking more positive. We're trying to shift over positive on the daily charts, but we're actually showing a little bit of weakness there, where we're looking more positive here longer term. We're going up with the slope in the TSI. Those are the short term, and we're above these lines though, so we're getting a little extreme. Now you could say, well, the S&P was going up and this is a negative divergence. Yeah, it is, but we go with what the momentum is for right now. In the intermediate term, the MACD, the PMO, and the PPO are still looking positive. Those are intermediate term oscillators. And then two longer term oscillators are the TRIX and KST, and they're starting to look a little bit more positive now. Shaken money flow. This is causing a little concern on the daily charts because we've been going up, and the shaken money flow is actually going down. It's still positive. We're also seeing that trailing off here. This is a smart money indicator. And the fact that this is going down is causing us a little bit of concern. We also have the Chaikin oscillator also going down even with an up week. A little bit of a concern here. The force index is still looking more positive, and it's above zero. We're extreme positive with the money flow indicator. We had an up week, not as much as the previous weeks, but we're still above zero on the 1 week rate of change compared to the week before. The 50-week rate of change, we're tending to go sideways. We're above this red line, so we just want to make note of that, but it could still go higher than where we're at right now. The RSI, based on 14 weeks, is extreme positive, and we're still looking negative here with the special K, where the daily chart has been positive for quite some time. The Stochk RSI, a shorter-term oscillator that we use, is extreme positive. For right now, it looks like this is suggesting good momentum. The Williams percent R is also extreme, suggesting good momentum. The ultimate oscillator is above 50 and going up. That's positive. The Vortex is showing some improvement with the green line on top and starting to go back up. That's also positive. The Copic curve, we're just at the point of switching over to positive on the daily chart. This is another momentum oscillator. We have been positive longer term here on the weekly chart. And then we didn't hit any support levels on this longer term chart. So there's really nothing to show here. We're still going up, though, with our 253 period. Now, why 253 periods? Because that's pretty much the actual number of trading days each year. And so I just broke this out. When this is going down, that tends to be more positive. But the equity put call ratio has been acting kind of strange lately. So we just use that as part of our information gathering. For this to be longer term positive, we want to see this continue to go back down. We are continuing to go down here. When we look at the VIX and a 3-month average of the VIX and take a ratio of that, that is more positive longer term. And then our different charts. We're still looking good on a trending basis with the Heikin Ashi. The Kagi chart is up. The Renko chart is up. 3-line break chart is up. And with the equi-volume, this tries to take volume and price and put them together and make this pretty little red-green, just like the TV show, eh? And try to give you a visual representation of what's happening. Down below is the ease of movement, and this tries to measure the path of least resistance, whether it's up, down, or sideways. And the path of least resistance is currently up. We did get enough of an upward move this past week to have 2 green X's drawn in here on the weekly chart. We had 1 new X drawn in on the daily chart. We're working out of a double top breakout that was generated on the 13th of May. We're working off of a daily chart signal that was also a double top breakout, but generated 2 days after that on May 15th. But this is still looking quite positive for the time being. Momentum shows our long-term momentum. It's pretty much sideways right now, but still positive. Also sideways currently with the intermediate term and sideways with the short term. Now, all of these are weekly charts. So even though it says short term, that's short long term, if that makes sense. 50-day cycle, we're kind of midway through since we saw the new cycle generated on June 4th. Then looking at a trend, though, the Elders Impulse System has green bars, and that's a positive trend. The parabolic SAR, we're positive on the daily chart. We're positive here on the weekly chart. That's confirmation. Looking, and I finally changed this over. We're looking at July now, where we're the last, going back to 2020, we've been up 100% of the time in July for a return of 4.6%. Then looking at the indexes with no studies on them, we are coming off of setting recent all-time highs with the S&P. The mid caps finally are showing some strength here, but still have not broken out to all-time highs. We also saw a nice little upthrust here to the upper end of this trading range that we've been in 2024. Can this continue? Strength in the mid caps and the small caps is what we're going to be watching. And then the Dow is in an uptrend. It's above both of the moving averages. The NASDAQ is also in an uptrend. The NASDAQ 100 is in an uptrend. Here's another chart of the QQQs, which is the NASDAQ 100. Also, it was showed a little bit of weakness. You could say this is a doji right here where we open and then close just about at the same point. It was virtually unchanged compared to the rest of the market, but this is where we've been seeing a lot of the strength from. If there's weakness starting to develop, and we're starting to possibly look negative on the daily chart with the momentum of the NASDAQ 100, we'll see if that bleeds through into anything more significant. The mid caps still have yet to get out above previous highs. And here's the small caps, just right at the high end of this range that they've been in. The NYSE setting all-time highs and in an uptrend here. The Wilshire, this is a daily chart coming off of a recent all-time high. All stocks are really looking good here. The big software companies not really breaking out, but still looking positive. The FANG index coming off of setting a recent all-time high, but was ended up being down 2.5% on the week. ARK just not participating. And we are still seeing a recent death cross here longer term. We're also dealing with a death cross on the daily chart. And I know that's very disappointing to a lot of folks because you got into ARK when it was really screaming to the upside. You follow Kathy Wood, you probably watch her videos, and about the time you got in is when this thing just turned and went down the toilet. Looking at the banks, we did see an up week with this weekly chart here. We're going up with the RSI. The momentum is negative, but trying to turn back positive. Then the deposits, is money going in or coming out of banks? We actually saw some outflows here recently, but if you look at the number up here, money actually went in. And looking at traditional Dow theory, which really just takes the Dow and the transports, I also add utilities to that whole mix. Where we're looking better here with the Dow, we're just not showing much of an improvement yet with the transports. That's been another disappointing area. Where the utilities had a really good week. They were really screaming to the upside, fell back, and now they are possibly going up again. Looking at the CRB index, this is commodities, where we were down a little bit, but we're still in an uptrend here on the weekly chart. Oil, we got up into a little bit higher into the 80s, and we're still at the 82 range now. Copper is down a little bit here. Now, this could portend to possible economic weakness, so we're going to be keeping an eye on that. The dollar is still in an uptrend, both on the daily chart and here on the weekly chart, but it did have a down week. Gold, even though everybody's gold everywhere, buy it now, buy it on Sunday afternoon, do it. We're just going sideways here in a range, but we are in an uptrend. Silver also has been chopping around and also in an uptrend. Looking at bonds based on price, we did see some improvement here with the total bond ETF. And the monthly chart here shows that stocks are still outperforming bonds. This is a daily chart. See how the rates have been coming down? And that's really been helping stocks. This is a weekly chart looking internationally with the US and UK rates being the highest. Then we have the German rates and then the Japanese rates here as well. Looking at some relative studies, oil is still doing the best so far in 2024, followed by stocks and then gold and then the dollar. Bonds are improving, but they're still negative on the year. Then some other relative studies. The NASDAQ 100 compared to the S&P 500 underperformed a little bit, but still looking pretty solid overall. We look at the S&P 100, which pulled back a little bit compared to the S&P 500, but still looking like it's in an uptrend with this ratio. Growth to value. This is what we want to see doing better. We're seeing value show some interest right now, and that's why we saw this ratio coming down. But longer term, we want to see this ratio going up, showing that growth is outperforming value. Growth is buy low, sell high. Value is, things are going to fall apart in the stock market. We better get defensive. Gold to S&P ratio, you still would have been better off just going with stocks when you compare the two with each other. Also seeing a little bit of a breakout as gold saw some upward moves recently as the dollar's been under a little bit of weakness with this ratio. Bonds continue to underperform stocks when we look at it in a different way here. Low volatility stocks. This is also another area that folks get into when we're more defensive. When we look at low volatility by itself, it's in an uptrend. But when you compare it to the S&P, it's really, really underperforming. And discretionary, this is like Amazon and Tesla, showing some improvement here, but still working off of a recent death cross when we compare it to staples. Discretionary makes life fun. Staples are like toilet paper and toothpaste, the things that you have to have. Energy to tech shows that energy is now back to underperforming tech. That means tech is outperforming energy. And then some longer term studies here with the trend. We're still working off of this signal that was generated way back now in October 2022, and that's still on the books. Also, we are still dealing with a ZWAG NYC breadth thrust. These are good for a year, and this was generated back in late October, early November of 2023, and that is really good looking forward. We almost saw another one back in April into May, but it missed it by 1 day. But this is still holding up quite well in the meantime. And this just shows you, going back to 1945, when these WAG breadth thrust signals are generated, going back to World War II, the returns are just really solid. And the further out you go, you're getting to almost 100% uptrends at that point. This is the NYSE Zahorchak method, very long-term buy or sell signals. We've been on a buy signal for a long time now, for pretty much all of 2024. This is a long-term chart of the S&P going back to the 87 crash. We're well above that. This is a further breakout of that same chart where we're just continuing to go up further away from this trend line. This is the NYSE new highs minus the new lows. Now that's a raw score. And then over top of that is a 50-week moving average, 50-day moving average. And this had been declining even though it was above zero. The fact that this is turning back up is more positive. And then we look at that same thing, but we apply it to the S&P 500, where this is starting to go back up as well. That's turning more positive. This is the NASDAQ 100 weekly chart going back to 2009. That uptrend is still very much intact. This is a NASDAQ 100 to Dow ratio. We broke out above these previous ratio levels, and this is still holding up quite well. We look at the QQQs to the small caps. It's coming down because we saw some weakness in the Qs and strength in the small caps, but we're still well above this previous ratio high. Semiconductors to the Dow saw a little bit of profit taking earlier in the week with semiconductors, but this is still really holding up well longer term. And then this middle area is what I really pay attention to. This is the new highs, new lows for the NASDAQ on a cumulative basis. So it just has a running total, basically. This had been declining for years, and we were starting to see an improvement, and it's still going sideways. This is a daily chart. So on the bottom, these are just raw scores from day to day. The more we can stay above zero, the more this calculation is likely to look more positive. And we want to keep an eye on the 3-month yield, and it's just been going sideways for the time being. We are dealing with the Hindenburg-Ullman right now. We had one signal. We're waiting to see if there's going to be a confirmation. The perma bears love this thing, and they're already screaming for this massive decline. Of course, they see a 3% decline, and they call that a crash for some reason. If you want to pause this, this goes into all the theory behind the Hindenburg-Ullman. I go to the next chart here, where we saw a spike earlier in the year back in February, but not a confirmation spike. Then we saw another spike back in May, but not a confirmation spike. Now we're getting another spike up, and we have 20 trading days, which will take us till August 2nd to see if we get another spike. If we do, this is what has happened in the past. This was right before the whole COVID crash right here. This was right at the end of 2021, and we really haven't had one since then that's been confirmed. Doesn't mean we take this as gospel. It just means that, okay, we're getting a confirmed Hindenburg signal here, so we better pay attention. Because we've been getting lots of confirmation signals here when we look at the NASDAQ, but look at what the NASDAQ's been doing. It's just been going up. Seasonality, and I have a number of different charts, a number of different ways here. This is July, where we tend to see things going really well about halfway through July, then potentially some weakness when you go back to 1950 on election years, and just use that as the calculation. Another chart, this is looking more positive, where we were really in a difficult time in the early 80s and then took off to the races after that. We're seeing a similar thing where we had a difficult 2022. We were starting to look better in 2023, and we've been doing well into 2024. When we look at July and we go with the monthly returns, this isn't daily or weekly, this is monthly going back to 1950. July tends to perform rather well. When we look at a global measurement here, July is also one of the better looking months. And then we have June, July, and August. What happens during an election year, and they all tend to be positive, where July is the least positive. And then this is Stock Traders Almanac comparing where we were at. Now, this goes back into June, so this is a bit outdated. Look at these other lines here, the red line, the green line, and all these other pretty colors in here, where we tend to see more positive action. Now, we're tending to go with the top first quarter. That's because we had a really, really good quarter in 2024. Well, we don't know that yet. We're just starting to get earnings reports for the second quarter, so we don't know if this is going to follow through or not. And then, so then we were going with the green line. This is when the sitting president is running for re-election. Well, we don't know that right now either for any certainty. So just look at this, kind of the big picture, that we do tend to be positive during an election year when you go from 1949 to 2023. And then looking at the election year here, this is also a bit outdated. This goes back into April. Take away this green line going up, and that tends to be more positive going forward. And then looking at the NASDAQ, where we do see a real solid beginning in July, but then some weakness. Are we starting to see that now? And then looking at the election seasonal pattern here, when you compare it to 2012, this is also getting a bit outdated here. But going forward into July, we tend to see some positive action when we compare it to 2012. There's another look at the 3 months broken out, where we have a good June, an even better July, and an even better August when we go from 1928 to the present during the fourth year of a presidential term. Blah, blah, blah. Then this is the past 20 years have actually looked the best. That's the green area. All of these are positive, but when you break them down over the past 10 years, 20 years, since 1950, they all look pretty good, but the last 10 years have been the best. And then we're trying to match up here with July, where we actually look a little bit better, according to this chart, during a non-election year, non-presidential election, where we see more choppiness. And we have the conventions coming up, and that could play into some things that are going on. The first part of July tends to be positive. The second part is positive, but not by very much. This is looking at that same thing, where the first part of July is usually the best performing part of the year, where the second half just kind of mingles down with more average returns. This is also looking out over June, July, and August during an election year. And then we're up 9, down 9 when you look at the election years going back to 1950 with a return of 0.7%. And then this also shows July best S&P and NASDAQ month last 21 years, where we've really gone up with the NASDAQ, and we've also seen good returns with the S&P. Thank you. I really hope you found this helpful. Please feel free to check out the daily videos. But even if you don't, I still hope you have a wonderful weekend, and I will talk to you in the next video.